If you're worried about inflation, if you're worried about competition, if you're worried about corruption, if you're worried about taxation, you want to run to the least risky thing you can find, the thing that's hardest to corrupt, that's hardest to tax. What is the product of Bitcoin? When you buy a Bitcoin, you're buying 1/21 millionth of all the money in the bank forever. That's what you're buying. What will the product be in 1,000 years? 1/21 millionth of all the money in the bank. It's the same every year for 1,000 years, right? If you're looking for the lowest risk place to go in an uncertain world, Bitcoin is the low risk institutional grade asset. So as I look out at all these risks, I say everything else you could buy is riskier. Bitcoin is the least risk. And that's why it makes the most sense, because every intelligent person is going to run away from those stocks, away from their real estate. They're going to sell their real estate. They're going to sell their stocks. They're going to sell their gold. They're going to sell their commodities. They're going to buy Bitcoin. There's nothing that's more robust that you can get your hands on.
Crypto markets across the board have pulled back around 30 to 40%, invoking fear in investors and speculators alike. It's a far cry from what many top analysts in the space predicted for December, with models such as Plan B's stock to flow breaking down, as well as Raoul Pal Adoption models. A lot of the current fear in the market can be attributed to one thing: inflation. As inflation numbers continue to soar, investors scared of rate hikes and quantitative easing in 2022 begin to go risk off on assets. In a time like this, I think it's a timely reminder from Michael Saylor to explain why Bitcoin is the ultimate inflation hedge. In his latest interview, Saylor dives deep on why inflation is even worse than reported and why there is no better place to park your money than Bitcoin. Make sure to stick around to the end of the video, where I will cover the latest on-chain Bitcoin data to see where the price is likely to go in the short term. Also, only a small percentage of my viewers are actually subscribed. If you enjoy finance content, consider subscribing or liking the video. It's free and you can always change your mind.
The price of everything you want to buy is going up, but the inflation rate is not a scalar. It's not a single number. I can measure the inflation on consumer assets if I want, like what's it cost to rent an average house, and what's it cost to buy a Domino's pizza? What's it cost for Netflix? Or what's it cost for canned food or cereal? That's a number. That number is normally not going up as fast. I can measure a different rate, the rate at which really good houses in the Hamptons go up in price, luxury real estate, or an Ivy League education, or if I go to a doctor not in my healthcare system, but outside of my healthcare network, or a really good dentist that doesn't take my dental insurance. That inflation rate oftentimes is 15 or 20%. I can measure the inflation rate of assets, scarce desirable assets, like stock portfolio. That's 30%. I can measure the inflation rate of a bond. Well, a bond that yields $50,000 in interest a year used to cost $1 million when the interest rate was 5%. But when the interest rates got driven down to 1%, that $1 million bond now cost $5 million. Wow. So the cost of an annuity, or the cost of early retirement, if you will, went up by a factor of 5. That's hyperinflation. So inflation is really a question of, it's a function of the person and what they aspire to buy. And if your aspirations are to live in your basement of your parents' home and watch YouTube and travel around by Ubers and watch Netflix and eat Domino's pizza and manufactured food, then the inflation rate is low. If you actually remove from the index the highly volatile food and energy, when we create the PCE index, it removes food and energy. If you remove food and energy and you keep the other manufactured stuff, it's even lower.
And PCE is what the Fed looks at when they measure inflation.
Oftentimes, yeah. But if you put luxury goods and elite experiences and scarce things, if you put trophy assets or stocks or bonds or commercial real estate, that inflation rate is much higher, right? We can see that the Case-Shiller index is up 27% year over year. Producer price indexes for commodities are up 20, 30, 40%. Stock portfolios up 30%. So you see, if you aspire to stay wealthy or to be wealthy, your inflation rate is not the CPI or the PCE. Your inflation rate is probably more like the return on the S&P 500 index. And so that was 10% a year for a decade, and now it's 30% a year. And so if you wish to protect your family's well-being over a long time, then you're not going to be able to invest in assets that only go up 2% a year or 5% a year. That means that most bonds that yield 3% interest have a negative real yield. Negative 2% against the CPI or negative 3% against the CPI, but that's not really the problem. The problem is they're minus 27% against the S&P, right? So your index ought to be something more like that. If you're the CEO of a publicly traded company, you're expected to keep up with the S&P 500 index. So the inflation rate for a CEO of a public company would be the S&P index, which is 30%. So now, if you're Apple Computer and you have $100 billion in cash and you're generating 1% interest on it, and if the inflation rate's 30%, you're losing $29 billion a year in shareholder value every year. So you see, it becomes a much bigger issue for companies that have large cash positions on their balance sheet. I think Berkshire Hathaway has $150 billion of cash. So $150 billion of cash not invested in the market is a loss of 30% of that, or $37 billion, right? Some large amount of money. And it'll continue year after year. And so that's why this is coming to the forefront right now. You could ignore it. You could ignore it if you thought the inflation rate was only 2%. But when you see all these assets going up much faster than 2%, you realize there's something else going on here. And once you embrace the idea that inflation is a vector, it's not a scalar. A vector meaning there's a different inflation rate for every product you want to buy in every jurisdiction where you might be, and it's changing all the time, right? That the way you describe fluid dynamics or aerodynamics is vector calculus. You would never try to describe those things with arithmetic. You couldn't model. You can't model fluid flow around an airfoil with arithmetic. It doesn't work. So once you understand that inflation is a vector, then you start to realize that conventional remedies won't work. You can't save your money in a savings account. You can't hold simple bonds. You're going to have to find some other inflation hedge, and that leads you to look for scarce, desirable assets. And the scarcest, most desirable asset in the universe is Bitcoin, because Bitcoin is digital property. It is all the benefits of gold, all the benefits of property, all the benefits of money without inflation, without friction, indestructible, immortal, move at the speed of light, programmable, and everybody wants it on Earth, and you can send it to anybody on Earth. So that makes it kind of the ideal solution in an inflationary environment. I guess one more point that I should make is inflation's bad in the US. It's much worse everywhere else in the world. Whereas the United States dollar might be losing 30% of its purchasing power a year in the last 12 months. But in Argentina, they're losing 60 to 70% of their purchasing power a year.
Wow.
And in Zimbabwe, in Venezuela, and other weaker regimes, they're losing 90% and 95%. So lots of people live in economies where the currency is collapsing. 30% is kind of a collapse, but 90% that's what happened in Lebanon this year. It's complete collapse. So if your currency is collapsing and you don't have ready access to buy the NASDAQ stock index or the S&P index, then Bitcoin is your solution, because you can put Bitcoin on any mobile phone. So all you got to do is have a mobile phone, and then you can protect your wealth from debasement, and you can conserve your property.
So there is Michael Saylor with why inflation is thought about and reported on completely wrong. If the recent market volatility has you freaking out, shift your focus longer term. Now, to cover some of the latest on-chain Bitcoin data, some follow-up hopium on this latest Bitcoin dip. Out from Will Clement, he highlights a key on-chain difference we are seeing during this latest dip and why it appears it will be short-lived. As you can see, a strong bearish signal is when we see a bearish divergence in the illiquid supply shock ratio falling whilst the Bitcoin price is rising. The opposite to this is a bullish divergence in which the price is falling yet the supply shock ratio is going upwards, as this means despite strong hand wallet addresses holding onto a higher percentage of Bitcoin, the price is still falling. Good news is that this latest dip is a very strong bullish divergence. The supply shock ratio is heading sharply upwards as the price slowly grinds down. Strong hands are wallet addresses that historically take in and hold more than 75% of their Bitcoin, so what this data is telling us is that strong hand holders are buying heavily into the latest dip, suggesting it will be short-lived. Anyway guys, hope today's video provided you with some value. I'll see you all in the next video, and as always, have a great day.